Hey, welcome everybody. This is a quick update on the volatility index. Had some questions. Someone wanted to know how much time is this product in the market. As you can see from this chart, this is a short only version that we're using for a fund we're launching. And as you can see, it only takes shorts. Why? Because this is in a product that is just basically destined to go down when stocks go up or there's no volatility or threat of a market that's moving. So the contango crush, this is an exchange traded note, the VXX, and it won't take long to learn the structure of this. And I think once an individual investor does, they'll feel more comfortable. Just like anything, if you're trading futures on E-minis, if you're trading stocks, if you're trading options, you should know the rules and the dynamics of what you're trading before you begin to trade. So, I mean, if you have a trading account, if you have a computer, if you have a mouse, and you have money in your account, you could easily learn how to trade this product. More importantly, you could simply learn to follow some of the signals and the trades in the volatility system that we've put together here. Now on the short only version, we have a very dynamic rate of return. As you can see, it's just stellar. Periodic returns, I mean, not every day's a winner, obviously. Looking at the monthly returns is so far this year is off the charts. Looking at our annual returns since inception, going back since 2010, not bad type of returns. This is based off of a $100,000 account. Let me share with you a couple things because the settings are proprietary, but let me share one thing with you. Just so that you can see, we're sharing with you. There's 9 functions that we've built into the Algo Optimizer. Everything from position sizing, risk, etc., etc. This has 3 different position calculation methods. It's set at number 1, which means it takes $100,000 capital. It can, if you had only $10,000 a trade, or $50,000 or $25,000, basically it will put you in. If you want to be in. If you have $100,000 capital, it's going to put you in as many positions as $100,000 will allow. So you're not trading a market on leverage. That's number 1. Okay, so you're trading mark to market on this account. So this is a $100,000 base account. You can also set it to number 2, and number 2 setting would be don't take anything more positions. If whatever the risk is, put me in X amount of position if I only want to risk $1,000. But if the risk is $3,000, you're not going to be in as many trades, right, or positions. And then the position calculated method we use for futures is set at number 3, which is 2 lots, so that we can define the performance over time. All right, so that's this model. I just wanted to make sure that we were all on the same page. Now, for all our clients that have received a license, we have so many licenses that we've created for the Person Algo Optimizer. They got this strategy, which takes longs and shorts. And we've had some people ask questions, good questions, but some of those questions are kind of proprietary. One question someone asked was, and I'm not sure we answered it, but how much time is it in the market? Well, as you can see, it went short, and it missed a trade for about 3 or 4 days. It's had some trades in here that weren't great, minimum losses, been in the market, it reversed, it was out of the market for a little while, out of the market for a little while, out of the market for a little while. Anyway, here's what I wanted to point out to you was to follow up on the latest signals. So we had a video where we stated it was short, and basically what had happened is that the market gapped higher, it got out, but its buy signals generated, so it went long, and look what it did. It got out at its intended profit. That arrow right there shows its exit. Now, at one point it could have continued to go up, and it doesn't matter. It hit its max profit. That's it. As you can see, what had occurred is the market went down and it went short, and it is short right now ahead of the Fed meeting, which means the S&Ps are probably up. Now, because the volatility, the VXX, goes down does not necessarily mean that the stock market goes up. It means that there's less demand. There's 2 effects on the VXX that take place. one, a contango crush. Remember, this is an exchange traded note. It trades off VIX futures, the front two first contract months. As we get closer and closer to the end of 1 month, we're going to come through rollover. A front month futures contract in April, as it's now March, and every day goes by, March becomes closer to April. What is April? Is it a futures contract or the cash? It's the cash. That's the contango crush. So without a shoot a drop or any type of volatility disruption, the contango crush will cause the VIX to go down. That's why it's a great shorting opportunity. Every once in a while in the stock market, you get these volatility thrusts and you get these scares in the market. And yes, the volatility goes up and we catch these little waves to the upside. But the performance and the best performance is on short only. But in this environment, after 9 years of straight up market almost, we want to have both sides, buys and sells, working. And that's why we have another stellar, insane, new profit high on the system. Now, what's going to happen today? I don't know. But I can tell you this. If it goes down a little further, it's going to take out its profit because it has a max profit target set right now based on its history of its trading. So even if the stock market goes up forever, this will get out of that one trade until a new setup is determined. Now, at what level would that be? Somewhere down here would be my guess. Next, here's where we're short from. And here's an open trade profit. How do we know that? Well, closed profit was at 946,000 year performance to date from 2010, and we have an open trade profit you could see of 951,000. So quick math, you could say, gee, you got about a $5,000 profit. Is there a trailing stop function in there? And the answer is yes. And so if the market pops because of the Fed, this thing will stop itself out, and we will let it ride while having an automatic trailing stop feature in the market. So I just thought you would like to see that and know what is going on right now. Now, let's look at some other markets which might have a reflection of interest for you guys, especially Euro currency, as well as I want to share some of the equity and what happened with crude oil yesterday. Amazing trading opportunities. Let's take a look at these trade setups. All right. First and foremost, we're going to take a look at crude. This is a 15-minute model. If you're a Thinkorswim client, you get to obviously see the PPS indicator. The daily, weekly has been in a buy in crude oil. Let's go take a quick look at that and then get back as we go to looking at futures. Let's go up to just look at crude oil. And you'll notice at least the daily on crude oil has been in that little PPS buy mode. So you can double check that all for yourself on Thinkorswim as well if you're a Thinkorswim client. Here's as well as Genesis Trade Navigator. I mean, it's the three platforms that we use: Genesis, TradeStation, Thinkorswim. Anyway, here's what we have noted that this market, while it's been in a bull bias, I mean, from yesterday, long positions out, went short, made a little bit of money, got chopped up just a tad, did all right. And then, again, if you'll notice, this system does not trade during these hours. There's just no trading. We turn that off. It's a select. One of the many features of this that we've programmed is to optimize the best time of day to trade for day trading and to have multiple sessions that you want to trade. So if you want to trade the European session and from 2 to 4 in the morning and then turn it off, take any trade between 2 to 4, turn it off. Or take long only, turn it off. Or take short only and turn it off. And then turn it back on to trade during the open outcry. Or just, start trading it from 2:30 going forward. And as you can see, it's taken some trades. Got a little dicey in here and then has been long and just went short crude oil right up here at 65.06. This is a system that just keeps ticking away, and then overall performance is, again, I wanted to point out, this is the May contract. In futures, when you're trading, you got some of these commodity markets that have continual rollover. So you got to be on top of a trading system. So you go from, February to March to April, and now we're trading the May contract. So crude oil is the one market that has a constant rollover every single month. And people ask, well, when do you know? Well, generally speaking, if you're in the middle of the month, so if we get in the middle of May, or excuse me, if we're in the middle of April, the May contract, you're going to roll over into June. So as soon as you get to the next month, or like right now we're March, so we're in the middle of March, we're not trading April, we're trading May. So as soon as we get into April, the middle of April, we roll out of trading a May contract into a June contract. That's I guess a good rule of thumb going forward. Okay? All right, let's look at the euro currency right now. We haven't given a lot of attention to the euro currency, mainly because the volatility in the ATR is just so, what's the word I'm looking for? Poor. I was going to say something else, but it's just poor. Let's take a look at how poor. All right, so if we go up to my radar screen here and we go to euro currency, and I want you to focus in on the euro currency, you can see we have an ATR of about 86 points. 86 points. That's a 10-day ATR right there. What does the ATR stand for? Average true range. So average meaning what is the daily range averaged over the last 10 days? About 86 points. Used to be 150 points. And then if you take a look at the last few weeks, we'll go to a weekly chart. You can see as we got into 2018, we did get a little uptrend. And then over the last 1, 2, 3, 4, 5, 6, 7, 8, 9, almost 10 weeks, we have gone nowhere. It's been a nowheresville type of trade. This is a euro currency, a weekly chart. So even with Brexit and all the other dynamics that was supposed to happen, the euro currency, and of course with Trump and again the tariffs and the this and the ECB and everything else, no volatility in the euro currency. So it's kind of thrown, maybe because everyone went student body left to Bitcoin, who knows, or to cryptocurrencies and that big rave. So I still think that we get dynamic trades, and I just wanted to share with you, you can get nice setups. And again, you'll probably say, well, why didn't it take a sell signal here? Because it's not programmed to take trades in this time frame. But it is programmed to take trades starting when? Probably right as the European session time begins. This did take a nice little short. It scaled out of half the position. It trailed the balance. It had a long. It said, oops, not a good trade. Reversed, got short, made more money. So this is a system we just rolled out of the March contract into June. And you can see this is June. And we take the signals here. It takes a little short. Takes a little hickey, went long, made a little money, reversed, went short, and it is now flat ahead of what? Well, actually, it's not quite flat. It is still short one. It trailed out of half the position. So this is a function that we allow it to trade two lots. It went short. You can see it's out of one. So what does that mean? It's still in one, and it will trail the stop. So if the market, just like this leg down, it got out with a nice profit on half, and it trails a stop on the balance. And that's another function of the algo optimizing settings that we have built into this system. Anyway, what's going to happen with the Federal Reserve today? It's anyone's guess, but let's take a look at other markets. So what's really weird is that as the dollar goes up, the euro goes down. Everyone knows that relationship, right? So as the dollar gets stronger, generally speaking, that's bad for commodity prices denominated in dollars. So what's going on here? Well, this is gold. Gold is not going down. In fact, today, gold's gone up. But what's neat is that down below, what you see is my proprietary volume indicator. It made a new secondary higher high on a volume divergence situation. Now, this is a 5-minute chart. It's currently short 2 contracts and about neutral. It's taken a bunch of trades today. It scalps out. It gets short. It got out. It got long. Got out. Now it's short. And I would imagine, on a major breakout one way or another with the Fed move, it will have flattened and reversed this position. It's pretty quick. In gold, it's fairly liquid, so we don't really get excited about or worried about a lot of slippage like other thinner markets can happen. But it is a concern, as always, that you get slippage because market could say something and you just get this huge gap. And if you're short, and that's where you're going to get filled. So we need to be aware of that. There's those added precautions that we want to take for any type of major market situation. But I think that seasonally speaking, gold is weak right now. Markets aren't behaving in a normalized correlation model. In other words, like I just stated, when the dollar goes up, gold goes down. Typically, gold and bonds have been correlated in direction. They're totally decoupled from their relationship. Crude oil prices straight up. Usually speaking, we see equity markets and crude oil trade in tandem, shows strength in the underlying economy and demand for products. So we have a lot of different correlations that we have to deal with, and I think right now what's really exciting about the Algo Optimizer, it's allowing us to take independent signals rather than look at correlations of the market, which tend to, or at least right now, are a little broken down. Anyway, as far as the Fed is concerned, I mean, obviously the S&Ps are the S&Ps. They're going to do what they're going to do. Technology, we have had a route to the downside, but not that bad. If you'd like, I'd like to share with you another moment here, the overall conditions of the technology sector Qs versus the Russell. All right, so this is the Russell and the IWM. Not a lot of media outlets give a lot of credit to this. I mean, it's kind of, they always talk about the Dow, the S&Ps, and the NASDAQ 100. But there are times where growth stocks outperform the rest of the market, and this could be that time. We do have a little channeling situation going on. The advanced decline has been improving by making a consecutive series of higher highs and higher lows. Now, this is the advanced decline as it relates strictly to the Russell 2000. And as you can see, over the last week and a half, the breadth of the market made this little zigzag pattern, lower low, lower high, and we're not quite out of the woods yet to determine, is this thing going to break out and go up back up to the upside. We are at what we would you see here is quarterly pivots. This is the person's pivot, the quarterly basis, which I've taught a lot of people, and we've put this out. It's not available on Thinkorswim yet, but many of you have looked at my work and know that the quarterly pivots is something that not a lot of people really know about. But I think we're so close to annual highs of the advanced decline, we could get a rip out of here. The volume action is kind of iffy, so if we do get a rip out of here, it's about a 163 to 165 breakout extension, not using Fibonacci, but just looking at this kind of ratio of what we've seen, and also price projecting up to the upside, which would be really strange to see because typically Ides of March we see weakness in the overall market, not strength. But with the breakdown in the VIX, with the strength in crude oil, it's hard to imagine where we couldn't see the Russell outperform at this point in time. So traders should be focused on that, and that has been one of our focuses with our weekly thoughts and observations newsletter advisory service. In any event, we'll see what the Fed has to say. They're going to raise rates a quarter point. We'll see if they just say, things are, tepid. We see weakness. Inflation's okay, blah, blah, blah. If they calm things down and make people less fearful that they're going to be 4 rate hikes or a half a point mixed in the mode, then my suspicion is that we see more upside first before we see the market crash. Thank you all very much. I hope you enjoyed this video update on positions, algo, and the market. Thank you.